For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, so we're not making any specific trade recommendations. Also, please be aware that your risk in trading can be substantial, so please make sure you are aware of all your risks prior to placing any trades. Also, please note that the presentation includes hypothetical computer-simulated trades and results. They're believed to be as accurately represented as possible, keeping in mind live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke Your Success LLC, where myself and our mentors are here to help you win in the markets and in life as well. And the type of trading that we tend to specialize in is called high probability options trading. This is where we utilize option strategies to make money from the passage of time rather than or in addition to price movement, meaning we can often make money if the market goes up, down, or sideways. Today, I'm here to share with you a little bit of a different way of trading. It's also options trading, but now we're going to treat it a little bit differently. We're utilizing these option strategies that have historically had an extremely high probability of winning and give very good results. And it's a way of trading where we can have a very low, what we call structural risk, so that if you get this horrendous down move in the market or some other such thing, you're not at risk of losing much more than you might expect, which is a problem with a lot of other different types of trading strategies. So the strategy that I'd love to share with you today is called the Super Bull. It's a strategy that could be traded on the Russell or SPX or really any asset. It requires a minimum of $1,000 to usually about $1,200. Our target is up to 100%, and our exit loss trigger is up to 100%, meaning that when you trade size, you need to make sure you trade size appropriately so that if you do take a loss, it's not too big of an impact to your account overall or your overall wealth. So the Super Bowl guidelines look like this. When the monthly expiration cycle is 65 days to expiration, we're going to enter a bullish call vertical in a manner where the potential profit and a total loss are about equal. There are some variations to the guidelines, but that's ideally what we would like. We are currently in an implied volatility environment that actually is not allowing that right now, but we're trading it anyway in a modified manner, which I will talk about as we go along here. And then once you enter this trade, there's really nothing to do until the next cycle is 65 days to expiration, and that's going to be about 30 days. So we put on the trade, we wait about 30 days, and after that time period comes to play, we're going to enter the next trade, and we're going to check on our original trade. If our original trade is up money, we're going to exit. If it's drawn down money, we are going to sit in the trade and we'll monitor that trade on a daily basis. If the market goes up, to see if that trade becomes break even or profitable. If it does, we are going to exit at our checkpoint time. Otherwise, we let it expire at what might potentially be a total loss. My point being that this is an extremely simple strategy. We enter the trade, we do nothing for 30-ish days. After that, we check it. If it's profitable, we exit. If it's not, we just go into more of a daily thing. If the market's going up, if the market goes down or doesn't go up, then there's really nothing to look at. And then at that point, too, we're also entering a secondary trade. And that's really pretty much it. And you just rinse and repeat. So really, anybody can do this. And if you want to get better risk-reward ratio. Right now, the Russell's providing a much better risk-reward ratio than the SPX, as well as other assets. We're going to demonstrate this on the SPX because that's what we have been doing for, goodness, 15 years. So let's talk about the historical probabilities of this trade and win rates. So if you took a look at this and you traded it in this method from the expiration of January 2011 to the current expiration cycle, you would have done 169 trades. The total trade for trade return, if we're using a planned capital of $1,000, is going to be 3,117.8%, which is very good. Our win rate is at the 88% win rate, which is, again, very high. Our maximum consecutive wins in a row that we've had is 31. That's almost 3 years without a losing trade in that time period. And our max consecutive losses is 3. The one caution that you want to be aware of with the strategy is when you take a loss, it's going to take out like three wins, right? So our average loss is about 3 times our average gain. So given this dynamic, we want to make sure that our trade size is small relative to our net worth or small relative to our account size. I would say a minimum size would be 10 times your planned capital. So if I'm doing this with $1,000 planned capital, then I'm looking at maybe a $10,000 account, or at least if you don't have a $10,000 account, plan if you have a period of consecutive losses or multiple losses in a short period of time, you're going to get that drawdown and you're going to plan on putting capital back in. So you want to make sure that you are aware of that. That said, this is a very simple trade. It is a beginner trade. We're showing you this completely not subjectively. We're not looking at the markets or anything when we're making the choices that we're making here. You can drastically increase the returns on this trade if you use a little bit of common sense and you're somewhat okay at judging price over probabilities. Meaning that the small capital requirement and the fact that it wins most of the time, it makes it a good trading strategy to use while you're learning to understand price flow in the marketplace. So that's one of the reasons that I do love this strategy. So let's take a look at the trade. And I'm going to show you October, the November, and the December trade. After I show you these trades, I believe we showed most of the trades for the year. And by the way, this trade has won the last 23 of the last 24 trades and has won over 20 trades in a row. So it's been doing extremely well, despite the fact that we're having some challenges with risk reward, which we'll talk about. So before we get into this trade, I want to remind you to make sure to like and subscribe to our videos. It helps us to continue to bring you this amazing content. So what we're going to do with the Super Bowl, it is Wednesday, August 14th, 2024. Our October 2024 cycle is 65 days to expiration. So we're just going to come in here and we're going to take a look and we're going to try to get a 1-to-1 risk reward ratio. By that, I mean, I'd like to get $1,000 in credit and $1,000 structural risk. So our structural risk in this case here is about $1,250. That would be ideal. And I really don't want to get much more than 10, maybe 20 maximum above the money with my long strike. And then I'm just doing a 20-point wing here. And I'm hoping to get that. Historically, before 2020, that was fairly common. We were getting in the $900 to $800 range. Post 2020, and then in this new environment, the implied volatility skew curve is such that it's starting to be a little bit even more than that. So in this particular example, we're getting about $750 to $1,250. That being the case, we are making a modification on this, and this is a bit of a loose modification. But basically, if I'm going to get a $700 drawdown with a 100-point asset move to the downside, generally I'm just going to call that a stop out and exit. That's going to reduce our win rate a little bit, or it would be expected to reduce our win rate a little bit. But it's going to help the challenge that we might have that if we actually do take a loss, that we're not taking like $1,300 losses. Realistically, we don't want to take more than $1,000. With that caveat, basically what we do here is it is 65 days expiration. We don't even look at this until 30 days by the guidelines. So if I go about 30 days and I go into September, let's just go to September 11th here. So on September 11th, if I ignore this trade here, what happens is I'm going along, I put the trade on, and I notice, hey, it is time for our November trade to be entered because November is now 65 days to expiration. So since November is 65 days to expiration, I come in here, I look at this trade, and I say, oh, This trade is up $233. Now, since we have the stop out in this, that would require, if the market ends up going down a lot, then you may want to come in here and see what your 100-point drawdown looks like. I can pretty much tell where that's going to be. So my stop out point based on my modification was at about 52.10. So if the asset point gets to around 5,300, then I need to know to come in here and look at this and say, hey, is this going to stop out? If I look at my price chart here, since my entry, that did not happen. We did get a significant down move, but we didn't get anywhere near where that would be an issue. So really no issue there. We closed this trade out at about a 20, we would call it a 233% on our planned capital. The planned capital number being over this, and we can discuss this briefly, being over $1,000 really isn't too much of a concern because we're dealing with a $10,000 account. So even if I'm overlapping this $1,200 with another $1,200, that's still no ways near my $10,000 number. So most of our account is in free cash. But that's the way we're determining these numbers, just so you know. And then from here, I'm going to say, okay, now it's time to enter my next trade. So I come in here, I look at where my asset price is. It is at about 54.40. If I come 10 to 20 points over that, I can go into my 55.60 long strike, do a 20-point wing, gives me about $780 or so on my credit. I decided to do the modification again, basically exit if we're much over $700 with a 100-point down move. Realistically, I could push that to 1,000 because 1,000 really isn't a problem, but I don't really want to get over 1,000. Just so happens, though, that's the way that we decided to trade it. And if we go another 30 days, as of the 9th, we are not exiting yet, but we're up $468. During this time period, we never got threatened to the downside. If we go to exit date, it's going to be, I believe, the 16th. And on the 16th, this is up $538. And I exit this because my December is now 65 days to expiration. I'm going to come in here and exit this trade out and take my $538-ish profit. And I'm going to re-enter here in December. And this time here, I am at 58.50 and 58.70. I'm getting a really cruddy risk reward ratio here. So I'm going to do the modification once again. And I'm going to say if I get to the point where I get like a $700 drawdown with a 100-point move, again, I'm going to push that a little bit. I absolutely don't want to go over 1,000, but this is where we start. And then if I go to November 6th, I'm up $188. It's still not time to exit yet. If I go another week, let me ignore my trades. This was where our next cycle was 65 days to expiration, or my January cycle was 65 days to expiration. So I come in here, I take a look at it, and I say, hey, look, this is up $368. It's time, it's up money. It's time to enter my new one. I'm going to close this at a $368-ish return, and then we will be set up for our next trade. And it's just rinse and repeat, rinse and repeat, rinse and repeat. And one of the things, like I said, I love about this strategy is it wins most of the time. Does it have its drawdown periods? Yes. Do you want to control your size? Absolutely. But for a beginner who's starting to get a feel of the market and just wants the experience of, doing okay and winning, then this is a great strategy to do that. And then, once you kind of get comfortable with your trading and so forth, and you want to learn more, you can come in and, join something like our Market Outlook membership, where you start to understand price movement probabilities. Then when you start to understand price movement probabilities, this is when your trading really takes off, because realistically, there are periods of time where I wouldn't be interested in entering this necessarily. There are periods of time when I would want to expire this and take my full profit, whatever that happens to be. And there's periods of time when I might be up money and want to exit because of certain charting events and probabilities that come into play as far as price movement goes as new information comes into the marketplace. And just doing this can make a very powerful income strategy for you guys. And just for reference, if we're using $1,000 planned capital, we had a 23.1% return. We had a 48.6% return and a 36.4% return on our 3 trades, making for a total of 108.1% in only about 90 days. And that is why I love the Super Bowl. This episode's winning trade. If you like what you see, I encourage you to come on over to lockeinyoursuccess.com. That's LOCKE in yoursuccess.com, and follow along with this and many other great trading strategies as they unfold during our weekly trade update webinars that we have with our Go members. There we cover 12 powerful non-subjective trading strategies. And not only do we cover the strategies as they unfold real time, but we're also continuously talking about the strategies and helping you gain an understanding of the benefits and drawbacks of doing certain types of option strategies. You can go to lockeinyoursuccess.com or thewinningtrade.com and learn about upcoming winning trade presentations. You can explore past winning trades, and you can receive free bonus material as well. And while you're there, make sure you check out our free trading performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any comments or questions, please feel free to post them in the comments section below. I answer all comments and questions personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.